why don't you start off by giving us your overall macro view and kind of the things that you have been thinking about over the last 2 weeks, and then let's go over some specific topics.
So the macro view hasn't changed significantly. I think we're just in an accelerated position now based on what we've been talking about for some years. And if I was going to broadly define that, it is a stagflationary environment. We are in a war economy. Whether people understand that or realize it or not is irrelevant. And in both of those environments, well, in a war environment, you typically have constriction of supply. And so while people have been very, very focused on GDP growth or on sort of macro numbers coming out, I think that's already priced into the market. A lot of that's priced into the market. What hasn't been priced into the market, in my opinion, sufficiently well, are issues surrounding supply, and not just supply of aggregate supply, but also, the breakdown of supply chains. So we can have, for example, tons of, pick your commodity, copper, oil, uranium. It doesn't really matter what that particular commodity is. But if your ability to get that to market is hindered or compromised in some shape or form, prices skyrocket. And so that is typically what you get in a wartime environment. We're already watching this rolling out. We're seeing this stuff in the Suez, right? We're looking at potential conflict in the South China Sea. These are all trade routes. And so where trade routes get constricted, and it's not just trade routes, but where trade routes get constricted, naturally your supply and your cost of moving goods accelerates. That environment, it doesn't matter what the Fed does, right? The Fed can raise rates, drop rates, they can print money. It doesn't change the fact that good A doesn't get to place B in time or at the same price. And so those are issues which I think are they're becoming more prevalent, and I don't see that going away. In fact, I see that accelerating. It's a broad thing. And then, of course, if we're going to look at the monetary side of things, the only tool that the central banks have to address issues that are in many instances of their own making, and in some instances synthetically of their own making, in other words, things like wars, come about as a consequence of monetary policy, they don't have any other tools other than screwing around with interest rates and increasing or decreasing money supply or credit growth and things of that nature.
I would argue they don't really have power over that either.
They're losing,
video.
But that's the only tool that they have, and so that's the tool that they're going to play with. So that's, as a broad context, that's our framework that we've been working with now for some years. And like I said, I don't think much has significantly changed, excepting that we are further down that path, and we are accelerating very, very quickly, in my opinion, towards some, I don't want to use cataclysmic, but there's event horizons which loom, which are extraordinarily dangerous. We've seen them in the Magnificent Seven. We're seeing it in the bond market. And so in many respects, I think for listeners, it's often a situation of knowing where not to be. That's kind of, was it Buffett? Was the first rule of making money, don't lose money. And the second rule, don't forget number one.
Yeah, right.
So if you're addressing and you're looking at where the most dangerous or the greatest dangers exist in the market, I think that's a very, very good step towards understanding where you might want to be positioned.
How do you reconcile the probability of consumer price inflation in the United States, or disinflation or deflation, with your view of the supply side of commodities, which we know is an input for pretty much every good or service, and the money supply growth? Let me be more specific. The increase or decrease of bank lending and bank credit.
We have, largely in the Western world and in the US in particular, a credit-based system. And most or much of the spend, and forgetting about the way that money comes into existence via the credit system, just in terms of your average man on the street, there is a significant portion of the cash that they're spending is actually credit. And so as you get through, or as you move through a tightening cycle, then it makes a lot of sense that the spending is impacted negatively as a consequence of less credit available, or the cost of that credit's higher, right? And so if you just looked at it purely from that perspective, you'd say, well, that's deflationary, right? So what do you do in a deflationary environment? Well, you go into cash and you go into bonds, typically, right? That's been the historical precedent for what you would do in that sort of environment. But at the same time, that's discounting geopolitical conflict. It's discounting supply chain disruption and all the other things that you mentioned. So this is a complex situation. It's not that simple as sort of looking at one thing in isolation.
That's the point I'm trying to make.
Yeah. Now, what the easiest way I think to describe it is to think of it in terms of the inelasticity, as you mentioned, of certain goods, which broadly we could define as Maslow's hierarchy of needs. There are certain things that you have to have, and you will forego other expenses in order to have those things. It's electricity, it's food, it's shelter. Those are your basic necessities that you will look after and forego other things. You'll get rid of your Netflix subscription.
Right.
You might not worry about all the apps on your phone, and you won't maybe upgrade your iPhone this year or whatever it is. So we have, if you're kind of looking at the broad economy, it's very difficult for me to conceive of an environment where I would want to be long consumer good companies. And that's despite the valuations that we're seeing in them, which are not particularly cheap. On the other hand, when we look at the, shall we say, the Maslow's hierarchy of needs type of component, and we've got a couple of slides. So growth, basically, we could say the Magnificent Seven. That's your growth companies, okay? Your value stocks are typically those which are income producing cash. They have a lot of free cash flow, typically don't have a lot of debt. Those companies have been discarded and left for dead for well over a decade now because they just haven't, the companies are doing well, but the share prices haven't done as well. And I don't want to go into the details of why that is. That's a whole different discussion. Nevertheless, we can see that divergence between your value and your growth is at an all-time high. And we've had, you could call it a triple top. Whether this breaks down this time or not, we don't know. But on probability, it's a decent probability that we've either reached the top or we're close to it. Okay, and when I say the top, it means that the value or the price of growth assets far exceeds those of value assets. And typically the trade that one would make in this situation is to go the other way. You would sell your Magnificent Seven and you would go and you would buy your value stocks. So that is just a broad sort of picture for one to have a look at.